Today, the Reserve Governor and the board met and they've kept the cash rate on hold at 1.5% for the start of the new financial year. Let's have a look at some of the economic data that we've seen over the last month. And on the positive side, we saw unemployment drop to 5.5%. Now that's the best reading since February of 2013. So that's the good news. And during that period, we did see some good business confidence and consumer confidence numbers come out. Now fast track to where we are today, we're starting to see some uncertainty and some sort of challenges in the economy. We've got a choppy economy at the moment, and that's reflected in some of that data. So business confidence has softened off a little bit, jobs ads growth is sluggish, and certainly consumer confidence has come off that short-term high that we saw as well. So broadly speaking, the economy really doesn't know which direction it wants to head. Now, a couple of other big changes that have occurred in regards to the turnover of the new financial year. We saw that in New South Wales and Victoria, some significant changes to stamp duty and some new policies to try and get first home buyers into the market. So those changes have occurred in many states, so check out the fact sheet that we've provided for you to sort of work out exactly where it sits in your particular state. We did see stamp duty concessions and savings, and also some introductions for investors to actually start paying stamp duty on off the plan construction. So there has been quite a few changes, so check that out in the fact sheet that we provide with the link on this video. Now, it's important to also then start to talk about interest rates. So the reason why the RBA is not doing any of the heavy lifting is because the banks and the lenders are doing it for it. Now, in the past couple of months, I've been talking about how APRA have basically put the bank's arm behind their back and not allowing them to grow their investor mortgage books greater than 10% per annum. Now, we've also seen a differential between principal and interest on owner-occupied mortgages, and now we're starting to see the introduction of penalty interest in a way for owner-occupied mortgages where it's interest only. Now, what we need to do is track that differential. So we need to think about that in terms of how it affects our personal household budget. And if the differential is starting to get too big, it becomes time to start talking to your professional broker. And obviously at Empower Wealth, we want to start talking to all of our clients around their personal circumstances. So it may be time to get a review done. And I say that because as those margins continue to grow, it's challenging to work out what is the best move for you, to stay interest only or to move to principal and interest, or potentially split that out into maybe a portion of principal and interest to get the lower interest rate and a portion of interest only. The third option you might also have is to look at fixing some of your loan as well. So you can still fix in an interest only position. And that way these out of cycle changes and surprises that we're getting by the lenders won't affect you for that period that you are fixed. So it's really important, my message to you today is really important, that it's going to be a case-by-case basis. There still is very much the case that interest only could be the best option for you right now if you want to continue to build out your property portfolio. But for some of us who aren't in a position or aren't looking to add to that portfolio in the short term, it may be advantageous to move to paying off some of that principal as well. Now in the past, you know, we do that traditionally through using an offset account, so having interest only and using our offset account to do that. But of course, these changes by the regulators are a catch-all policy, which means that they are implementing these changes for some of the uneducated money managers and people who are stretching themselves to get into property in maybe the outer suburbs. But what's important to us, that is catching us sophisticated money managers, and it's hurting us in regards to how we want to manage the money. So the fact of the matter is we're not going to be able to change these big macro policies that are being introduced. So this is why, you know, we're changing our position. We need to pivot with the market, and that's why you need to speak to one of Empower Wealth's mortgage brokers to get a sense of what you should be doing moving forward. Thanks for watching.